Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Much ink has been spilled and much tape has been consumed on the rising inflation across the board. But we still find many key points missing from these discussions. In this week's podcast, we present our perspective on inflation, which includes some points which we think are not getting enough attention they deserve. Inflation concerns have risen quite strongly across the board over the recent months, following rising and higher than expected inflation data releases. In the US, the Consumer Price Index CPI rose by 7.5% in January compared to a year ago. This was the fastest annual pace of rise since 1982. On a sequential basis, that is comparing month-over-month movement in CPI, consumer prices rose 0.6% from December, higher than expected but still down significantly from last October when the inflation rose 0.9%. Price rises for food, electricity and shelter were the largest contributors to the CPI increase in January. The core consumer price index, which strips out the volatile components of food and fuel inflation, still climbed 6% on an annual basis. Contributing to this rise in core CPI are prices of used cars, which rose circa 41% in January compared to a year ago, and shelter costs, which rose circa 4.4% on a year-over-year basis. However, we do expect these higher rates of inflation to start moderating over the next couple of months. We do believe that the headline inflation numbers continue to be massively distorted by some pandemic-related disturbances. Supply-side bottlenecks due to port closures and differences in COVID-19 policies across the globe have created an imbalance in supply and demand. We are seeing some signs of easing in this rather tight situation. Indeed, real-time indicators point to easing supply-side pressure on semiconductors used in producing new cars. This in turn should help reduce the demand for used cars as such and bring down the prices, which remain unbelievably high. Also, Baltic Exchange Dry Index, a benchmark for price of moving major raw materials by sea, has been falling in recent months, indicating easing pressure on inputs. Energy prices rose strongly over the recent months thanks to escalation in geopolitical risks surrounding some of the major energy producers. However, should the situation de-escalate, energy prices should give up some of the risk premium they have embedded in recent months, and they should reverse the energy cost inflation of recent months. Inflation so far has been driven by goods and less by services. Should the demand rotate away from goods into services, that could cause inflation to soften as well. Shelter costs have been driven by higher housing prices, but with a lag in the US. Here, the shelter costs could continue to move higher despite a moderation in house prices. On food, as we highlighted in our podcast titled A Pricey Porridge, dated November 22nd, 2021, the prevailing La Nina weather conditions point to elevated prices in the near term, but the condition should start to normalize beyond the spring months of the northern hemisphere. All this tells us that drivers of inflation are varied and in some cases perhaps not sustainable. Therefore, it is important to think deeper on what the central bank policy can affect and what it cannot. For instance, yes, the central bank tightening could help reduce the aggregate demand in some sectors, say the housing, but it can do little in terms of normalizing some of the supply side bottlenecks and extreme weather conditions. Of course, inflation is becoming a political issue and there are reasons why the current US administration would want the US Fed to bring down inflation quickly. But equally, if the Fed starts to tighten too aggressively, it would end up slowing the economy significantly in the months ahead and right into the midterm elections, which is also not an ideal outcome for the economy and the administration. Perhaps more debatable argument is, does the current CPI apply to all households and does it impact their standard of living to the same extent? For instance, the used car prices have risen strongly over the past 12 months. But are all US households impacted by this? Think about it. What we are surprised by is the dramatic market reaction to rising inflation in recent months. They have been pushing to hawkish extreme in our view. In reaction to last week's US CPI surprise, markets have quickly moved closer to a consensus of 7 rate rises by the US Fed this year. Not only this, immediately after the CPI release, the chances of a 50 basis point hike in March meeting have increased to 90% from under 25% just before that. The calls for the Fed's balance sheet unwind have strengthened. But what we found dramatic were the calls for the US Fed to do an extraordinary rate hike. That is, a rate hike in between two scheduled meetings. All this is happening against the backdrop of flattening yield curve, which increases the risk of an inversion, which in the past has signaled an imminent recession. From our investment strategy viewpoint, this behavior of markets is what we described as the perceived policy misstep under the downside risk scenario in our reports and in our podcast titled 2022 Outlook Asset Allocation dated January 4th, 2022. But our base case still sees the Fed treading the path path of policy normalization rather carefully. And as we discussed in our recent podcast titled Fed's Humble and Nimble, Markets Wobble and Wiggle, dated February 3rd, 2022, we think Fed will likely remain data dependent, and this should see economic data inducing volatility into financial markets. This calls for investors to not fight the Fed, but stay diversified, disciplined, and focused. Our asset allocation strategy is to overweight cash, neutral equities and alternatives, and underweight fixed income. Near-term opportunities and risks emerge when volatile markets price in and price out certain risks. So the key question to ask is, what is priced in? Stay tuned for next week's podcast, where we would be discussing the risks facing financial markets and how much of those risks are already priced in. Thank you for listening to this podcast. If you found it useful, please do share it with a friend or a colleague. You can always reach out to your ADCB relationship manager with any questions or comments. You can also log on to our website www.adcbam.com for more information. You were listening to the Global Investment Insights podcast brought to you by ADCB Asset Management, and my name is Kishore Muktinutalapati.